This recording will cover Chapter 6. We look at risk, return, and the capital asset pricing model. So what are returns? Investment returns measure the financial results of an investment. Returns may be historical or prospective. By prospective, we mean anticipated. Returns can be expressed in either dollars or percentage. So measuring returns in dollars is easy, but there are two problems that may arise. You need to know the size of the initial investment to determine if it's a good return. $100 on a $1,000 investment is good, but $100 on a $10,000 investment isn't so good. And you need to know the timing of the payment. A $100 return on a $1,000 investment the following year is good, but if you have to wait 20 years for that $100 return, that's not so good. But here's a little example. If we have an investment that costs $1,000 and is sold after 1 year for $1,100, we can calculate our dollar return. It's simply the amount of dollars received minus the amount of dollars invested. So that's $1,100 minus $1,000 to give us a $100 return. If we calculated the percentage return, that's simply the dollar return divided by the dollar amount invested. So that's 100 divided by the $1,000 investment to give us 10% return. To correspond with return, we also need to calculate the risk of an investment. Risk refers to the chance that some unfavorable event will occur. No investment should be undertaken unless the expected return is high enough to compensate for the perceived risk. Typically, investment returns are not known with certainty. So our investment risk is related to the probability of earning less than expected. The greater the chance that you will earn a return less than that expected, the greater the risk. To look at risk, we could look at probability distributions. Here we have two stocks. Stock A is the red line and stock B is the green line. And this is just plotting the chance of each return. The tighter or more peaked or the taller distribution, the more likely is the actual outcome. So the more peaked the distribution, the more likely that we will earn our expected return or the average. So the tighter the probability distribution, the smaller the risk. So in this picture, it's much more likely that stock A will generate its expected returns. There is a smaller chance that the actual return will end up below the expected return, or will end up different than the expected return for stock A than stock B. So we know this because it's more peaked, so there's less of a chance to earn something in the tails, in the extremes. So if we're going to look at different investment opportunities, we first need to talk about probabilities. The probability is the chance that an event will occur. And here we see that there's a 10% chance, here's the probability column. So there's a 10% chance that the economy will go bust, 20% chance that the economy will perform below average, a 40% chance that the economy will perform average, a 20% chance that the economy will do above average, and a 10% chance of an economic boom. and the corresponding returns for 5 different assets. Here we're looking at the first column is a treasury bill, and the treasury bill returns 8% regardless of the state of the economy. Alta Industry, the second column, moves with the economy. So if the economy is doing poorly, Alta does poorly. So it's positively correlated with the economy, and this is a typical situation. If we look at RepoMin, which is the third column, we see that it moves counter to the economy. So when the economy is doing poorly, RepoMin is doing good. When the economy is doing well, RepoMin is doing poorly. This negative correlation is unusual. Usually we see that industries move with the economy. So we can calculate expected returns, what we think an investment will return to us. And that's simply equal to the probability of an event occurring multiplied by the return in that state of the economy. And we add those up over time. So if we were to calculate the expected rate of return for Alta, we would see that the probability of a bust is 10%, and we multiply that by the return in the state of a bust, so a negative 22%, plus the chance the economy performs below average, 20%, multiplied by the negative 2% return that would be anticipated, plus the 40% probability of an average economic climate multiplied by the 20% return in that state of the economy, plus the 20% chance the economy will perform above average, multiplied by the 35% return in above average economic climate. And finally, we have a 10% chance of an economic boom, and if we have an economic boom, we expect a 50% return. So if you multiply all of this out, you'll get 17.4%. So we expect for Alta to return 17.4%. So if we did this for each of our different investment alternatives, we would see that Alta has the highest rate of return. But does that make it the best investment? There are other factors to consider, specifically the risk level of the investment. To measure the risk, we're going to use standard deviation. This measures the variation and it helps to gauge expected volatility. So a volatile stock will have a higher standard deviation. The standard deviation is the square root of the variance. And to calculate standard deviation, we simply take our observed return minus our expected return squared times the probability and sum that up over each of the economic events. So we can calculate the standard deviation for Alta. Remember, the standard deviation is equal to the square root of the summation of the observed return minus the expected return squared times the probability of the event occurring. So the standard deviation for Alta is equal to, I'm going to draw my square root at the end because I can never draw it long enough, is equal to our observed return in a bust economic state of negative 22% minus our expected return. Remember, our expected return was 17.4%. And we square that and we multiply it by the 10% probability. And we do that for each economic state. So plus the negative 2% return in a below average economic climate minus the 17.4% expected return squared times the 20% chance that the below average economic climate will occur, plus the 20% expected return in the average state of the economy minus the 17.4% squared times the 40% chance that the economy will be average, plus the 35% return we'll earn in an above average economic climate minus the 17.4% expected return squared multiplied by our 20% chance that the economy will perform above average, plus our 50% return in a boom minus the 17.4% expected return squared times the 10% chance of a boom, and all of this under the square root. If you calculate this out, you'll get 20%. We can do that for each of our different investment alternatives. And we know that the larger the standard deviation, the higher the probability that the returns will be different from the expected return. This measures the standalone risk of an investment. So how much risk does this investment hold by itself? So we can look at the expected returns and the risks together, but it's fairly difficult to compare these without having a single measure. Because yes, Alta has a higher risk than the repo, but it also has a higher expected return. So how would you compare them? The tool that we use is the coefficient of variation. If we must choose between two investments, and one has a higher expected return and the other a lower standard deviation, then we need something to make these comparable, and we use the coefficient of variation. It shows the risk per unit of return. It provides a more meaningful basis for comparison than the standard deviation when the expected returns on two alternatives are different. This is most useful when comparing stocks that have different expected returns and different standard deviations. To calculate coefficient of variation, it's equal to standard deviation divided by expected return. So we can calculate this for each of our investments. Again, coefficient of variation is standard deviation over expected return. Standard deviation over the expected return. Expected return can be written as E open parentheses R close parentheses, or R hat, or R bar. The book and the internet uses many different ways to express this. So if we were to calculate the coefficient of variation for Alta, 20%, divided by 17.4% to give us 1.1. So we can do this for each of them. For the market, it's the 15.3 divided by 15. So that's 1. For American Foam, it's 18.8 divided by 13.8, so 1.4. 0 divided by 8 is 0. 13.4 divided by 1.7 is 7.9. So this allows comparison for our different securities. Again, with the coefficient of variation, it's the amount of risk you are assuming in comparison to the amount of return that you expect to receive. The lower the coefficient of variation, the better your risk-return trade-off. So we're going to search out securities with a lower coefficient of variation. So here's an example to explain risk aversion. We have $1 million and two different ways to invest it. First, we can have the safe alternative. We can invest in treasuries and earn a 5% return. Or two, we can invest in a stock, and if the stock is successful, there's a 50% probability that it will be successful. Then our value of our portfolio would increase to $2.1 million. If it were unsuccessful, then it would be worth $0. So both of these investments have a 50% return, or an expected return of 5%. So which do you choose? If you choose the less risky investment, the Treasury security, then you're risk averse. Studies show that most investors are risk averse with regard to their serious money. So with the money that they're going to use to buy groceries or to pay the rent, they're not going to gamble with this money. You only gamble with your extra money that is not required for your survival. So what does this mean? Everything else hold constant. The higher the risk, the lower the price, and the higher the return. Riskier securities must have higher expected returns than less risky securities. And that's because people are risk averse. They must be compensated for bearing additional risk. But in the real life, we don't usually care about the risk and return of a single asset. No one holds a single asset. You usually hold multiple assets together in what we call a portfolio. So we're going to look at portfolio risk and return. First, we're going to assume that we have only two stocks in our portfolio. We have $50,000 invested in Alta and $50,000 invested in repo. So we can calculate the expected return and the standard deviation. To calculate expected return of a stock, it's simply the weighted average of the individual security returns. So Alta had an expected return of 17.4%. While repo had an expected return of 1.7%. So if we combine the two in our portfolio, then we can calculate the expected return of the portfolio as the weight in the first asset, so the weight in Alta. We have $50,000 invested in Alta, and we have a $100,000 portfolio, so 50% of our assets are invested in Alta. And that investment has an expected return of 17.4%. Plus, we have a second investment, and we have $50,000 of our $100,000 portfolio invested in RepoMin, which has an expected return of 1.7%. And this gives us an expected portfolio return of 9.6%. So when we combine these two assets together, we expect to earn 9.6%. There is an alternative method. You could find the portfolio return in each economic state. So we have a portfolio that is 50% Alta and 50% RepoMin. We add them together. So here for the first, it would be 50% times our negative 22% return plus 50% times our 28% return to give us 3% return. And we do that for each economic state. So once you've calculated the returns, the portfolio returns in each economic state, we multiply those by the probability of that economic state occurring. So we take our 3% and multiply it by the 10% probability of a bust. Then we take our 6.4% and multiply it by our 20% probability. Add to that the 10% multiplied by 40%. Plus 12.5 times 20 and 15 times 10 to give us 9.6%. Either way, you get the same answer. So now that we've calculated the expected return, we can also calculate the standard deviation. So we can calculate the standard deviation together. I know it's difficult sometimes to just look at a formula and see where it came from. So I modified this slide a little bit to make it easier to read. And we see that the portfolio we just calculated had an expected return of 9.6%. So we can calculate the standard deviation of the portfolio. And that's equal to our 3% return in a bust minus our expected return of the portfolio of 9.6% squared multiplied by our 10% probability, plus the 6.4% minus the 9.6% squared times the 20% probability, plus our 10% return minus 9.6% squared times the 40% chance, plus 12.5 minus 9.6 squared times 20 plus 15 minus 9.6 squared times 10. And all of this is under the square root. So the standard deviation of the portfolio is the square root of the return in each state of the economy minus the expected portfolio return times the probability of that event occurring. When we work this out, we get 3.3%. Now we can also use this to calculate the coefficient of variation. So remember, the coefficient of variation is equal to the standard deviation divided by our expected return of 9.6 to give us 0.34. So you notice some interesting things here. The portfolio expected return is between ALTA and repo returns. So with ALTA, we anticipated earning 17.4%, and with repo, we expected to earn 1.7%. And so this is simply the average of the two. The standard deviation, however, is lower than the standard deviation of either stock independently. So the standard deviation of each stock was, we can go back and see. Here we had 20% standard deviation for ALTA and 13.4% standard deviation for repo. And you see that when we combine the two, the portfolio standard deviation is 3.3%. So the portfolio is much less risky than either stock in isolation. And this is because the two assets are negatively correlated to one another. So when one is increasing in value, the other is decreasing in value, causing them to cancel the risks to cancel one another out. An asset that's held as part of a portfolio is less risky than the same asset that is held in isolation. Most financial assets are held as a part of a portfolio, and banks, pension funds, and insurance companies are required to hold diversified portfolios. So they're required to hold securities that are not perfectly positively correlated with one another. So it is possible for a riskless portfolio to form if the two stocks are perfectly negatively correlated. The risk level will not be reduced at all if the two stocks are perfectly positively correlated. In general, stocks have a correlation coefficient equal to 0.35, so risk can be lowered but not eliminated. So if we were looking at this, remember we talked about probability distributions earlier and how a more tightly peaked probability distribution is less risky than a flatter distribution. And you see that when you start combining assets together, the green line is the multiple assets together, the probability distribution becomes increasingly peaked, meaning that it is less and less risky. Almost half of the risk in an average individual stock can be eliminated if the stock is held in a reasonably well diversified portfolio. So this picture here, this graph, shows the portfolio standard deviation and how that changes with the addition of new stocks to the portfolio. You see that the slope of this line is greatest up here at the top. So we have the greatest risk reduction simply by adding one stock to another. This risk reduction is very significant until we hit around 15 to 20 stocks, and then it levels out. Once you hit 15 to 20 stocks, the incremental benefit of adding another stock is very small. So this line shows us the amount of risk, the standard deviation of a portfolio, and how that changes with the addition of more stocks. You see that it approaches a horizontal line. This horizontal line right here represents the level of market risk. You can't get rid of this risk regardless of the number of stocks that you add to your portfolio. The only risk that you can eliminate is this diversifiable risk that goes away with the addition of more stocks to your portfolio. So diversifiable risk is risk that's caused by random events. So lawsuits to a particular company, strikes, events that happen to a particular firm or industry. These are also called firm-specific risks. Market risk, or non-diversifiable risk, comes from factors that affect most firms as a whole. So things such as war, inflation, recession, or interest rates. And this risk cannot be eliminated through diversification. So as more stocks are added to the portfolio, each new stock addition has a smaller risk-reducing impact on the total portfolio. The standard deviation falls very slowly after about 40 stocks are included. The lower limit for standard deviation is about 20%. By forming a well-diversified portfolio, investors can eliminate about half the risk of owning a single stock. Most research papers say that you should hold 15 to 20 stocks minimum in your portfolio. At that point, the incremental cost often outweighs the benefit. So yes, you'll see reduction in your portfolio risk, but you're also going to see higher transaction costs because you hold more stocks in your portfolio. So it's not that the individual trade costs more, it's that you're having to make more trades, so you're having higher total transaction costs. So it is not possible for an investor holding one stock to earn a return that is equal to its risk. Rational investors minimize their risk by holding portfolios. So because they hold their stocks in portfolios, they're bearing only market risk. The one stock investor has higher standalone risk, so the return is less than that required by the risk level. So if we want to measure the amount of risk, the amount of market risk within an individual security, then we look at beta. The market risk is the only part of the risk that we care about when we hold a diversified portfolio. So beta is often written as a capital B with a long tail. And it's simply the correlation between the security and the market divided by the market standard deviation. The tendency for a stock to move up and down with the market is reflected in the beta coefficient. So an average risk stock is defined as a stock with a beta equal to 1. If a stock has a beta higher than 1, that means that it's more responsive to changes in the market. If it's less than 1, then it's less responsive. Beta measures the stock's volatility relative to the market, and we calculate betas using a regression model. So you run a regression with the returns on the stock in question plotted on the y-axis and the return on the market portfolio plotted on the x-axis. You calculate the slope of the line of best fit, and this is the beta. So if we have a security, the PQU, and we're comparing it against the market, we can calculate the beta. We can do this in Excel. You would simply plot the market return on the horizontal axis and the PQU return on the vertical axis. Find the line of best fit, and the slope of that line tells you the beta. So if we were to do that, and we were to put this line of best fit on here, we see that it's 0.83 times the market return plus this error term of 0.02. So the beta is this slope. It's the 0.83. Where do we get the market return from? A lot of analysts use the S&P 500 to simulate the market return. We typically use monthly or weekly or daily returns. Analysts and researchers differ on their methodologies. For example, in a research setting, you would not use the S&P 500 to simulate the market returns. You would use something like the entire CRSP database of stocks, which is all stocks that are traded on NYSE, NASDAQ, and Amex. So how do we interpret beta? If beta is equal to 1, the stock has average risk. If it's greater than 1, then it's riskier than average. If it's less than 1, it's less risky than average. Most stocks fall between the range of 0.5 and 1.5, and stocks can have a negative beta. So if they have a negative beta, that means that they are countercyclical to the market, and it's not very common. Again, beta is the most relevant measure of a stock's risk because it determines how the stock is going to impact the risk level of a diversified portfolio. And you can find beta without having to calculate it, without running regression lines. You can look at Yahoo Finance. If you go there and you enter in a ticker symbol and then click go, when the quote comes up, you select key statistics from the panel on the left, and it will tell you the stock's beta. So when we compare expected returns versus our market risk, which is beta, we can determine which stock is best. So Alta has the highest expected return, but it also has the highest level of risk, with a beta of 1.29. So which investment is best? It depends upon your risk preferences. Remember that risk and return move together. As risk increases, return increases, and as return decreases, risk decreases. So negative betas do exist, but they are rare. It simply means that when the market is doing poorly, this investment will do well. We can use the security market line to calculate each alternative's required return. The security market line is a part of the capital asset pricing model. And here, our investment's required return is equal to the risk-free rate times the market risk premium plus beta. And remember that the market risk premium is the market return minus the risk-free rate. So the market risk premium is the premium investors demand for bearing the risk of an average stock. And so if we assume that the risk-free rate is 8% and the market return is 15%, then the market risk premium would be 7%, the market return minus the risk-free rate. So we can use the security market line to calculate required returns for each of our individual stocks. So we have our required return for our stock of interest, and that's equal to the risk-free rate plus the market risk premium times beta. So here we said that the risk-free rate was 8% and the market risk premium was 7%. So then all we have to do is plug in the different betas to calculate our required return. So 8% is the risk-free rate plus the market risk premium of 7%, and Alta had a beta of 1.29. That gives us a required return of 17%, and we can do that for each of our securities. We can compare expected versus required returns. The expected return is 17.4% for Alta, but the required return is 17%. So if we can earn more than that required, we would buy. That means that Alta is undervalued. The market is fairly valued. T-bills are fairly valued. But RepoMin, the expected return is less than the required return, meaning that we would not buy, and this stock is overvalued. If we looked at these plotted on the security market line, we would see that those above the line, the American Foam and Alta, are undervalued, and those below the line, RepoMin, are overvalued. We wouldn't buy them. We can also calculate betas of a portfolio. The beta of the portfolio is simply the weighted average of the individual security portfolios. So if we invested 50% of our money in Alta and 50% in Repo, the beta of the portfolio would be 50% times the beta of Alta and 50% times the beta of RepoMin. And that would give us a weighted average portfolio beta of 0.22. So you can calculate the required return on the Alta repo portfolio. We have 50% invested in ALSA, which had a return of 17.4%, and 50% invested in repo, which had a return of 1.7%. Remember, that gave us our expected return. Or you could use a security market line. So we had said the risk-free rate was 8%, the market return was 7%, and our beta was 0.22. You get the same answer either way. We usually estimate the risk-free rate using the 3-month rate on U.S. Treasury bills. So the risk-free rate is equal to the real rate of interest plus this inflation premium, and we estimate that using T-bills. If we had a change in inflation, meaning the risk-free rate increased, the rate of return on assets would also increase. So this causes an upward shift in the security market line. So if inflation increases, the entire security market line is going to shift upward. If we have changes in risk aversion, that's going to cause the security market line's slope to change. A steeper slope in the security market line means that there is a greater risk aversion. So the average investor has a greater level of aversion towards risk. If there is no risk aversion, then we would see a horizontal line. But the capital asset pricing model has not been completely confirmed or refuted. The statistical tests that would make empirical verification or rejection possible are not available. So basically, the capital asset pricing model is based on too many theories that can't be proven. Investors' required returns are based on future risk, but betas are calculated with historical data, so that's one problem. And investors can be concerned with both standalone and market risk. So that concludes Chapter 6.